So let's say you bought General Electric, and it's paying about 3.5%. Okay? So you're collecting 3.5% of interest on General Electric. That dividend keeps the stock from going down. It keeps it from going down. Why? Because if the stock goes down to 17, okay, it's at 20, that dividend goes up because they're going to pay the same amount. Now they're paying 4%. People out there shop dividends. They go, 4%! I'm buying that. So it pushes the stock back up. A strong dividend will hold the price of the stock higher. So it gives you security. Dividends are at a terrific rate right now. And companies are starting to raise their dividend and invest more money in dividends. Great way to go for income and for growth. So dividends are big. All right, we talked about what makes the market go up. And we talked about some of the trends in the market. Now let's talk about what makes the stock go up. We buy a company for its profits. If you came into a bunch of money and you said, okay, I'm going to go out there and buy myself a company. And you say, all right, let's say just a small company, I have a choice of a hot dog stand or a falafel stand. Okay. Here in downtown Phoenix, that hot dog stand is making $1,000 a day. The falafel stand, because people aren't into Greek food as much, is making $500 a day. They both cost $5,000. Which one are you going to buy? The hot dog stand, because it's making more profit. That's why we buy companies. That's why we buy stocks. We buy them because they're making a profit. Now, how do we measure how much profit are they making? We measure it by a price-earnings ratio. Okay? So, price-earnings ratio. I use that term a lot with my clients, and I know that you probably know what this is, but let me just review it. This is how we value a stock. How much profit does this company make per share? And you have to do it that way because if you look at one stock, it might be $600 a share like Apple, or it might be $6 a share. You say, well, Apple's got to be worth more because it's $600 a share, but not necessarily. The price of the stock doesn't mean anything. The P/E ratio tells you where the value is. So, if the P/E ratio is the price of the stock over the earnings per share. So, an example is, if the price of the stock is 20 and you have $1's worth of earnings per share, then the P/E is 20. And if the price of the stock, another stock is 10, you have the same amount of earnings, the P/E is 10. So the lower the P/E, the better. Okay? Now the market has an average P/E. Back in about 2000, when we had the market was going wild. Do you remember that? The tech stocks were way up there. People were buying Microsoft, and it was like $90 a share, and Qualcomm was $250 a share, and there were a lot of very high price stocks back then. The P/E ratio back then was about 20 for the market, overall market. Very high. Now the P/E ratio is 11. If you take the average of P/E ratio of the S&P 500 stocks, it's around 11. Very low by historical standards. That tells you there's a lot of value in these gems that we want to collect. So the P/E is a primary thing we want to look at. Is the stock making a profit? And is the profit going up? Is the profit growth happening there? Very important. The other thing that makes the stock go up is that they have plenty of cash. They're safe. You know, people say, oh, stocks aren't safe. General Electric, I use that as an example all the time, is one of my recommendations. That company has more money than most countries. More money than most countries. Have you ever worked for a company and it's not run very well and you go, you know, I don't know how that company stays in business. Has anybody ever been there? I don't know how this company survives. I'll tell you how it survives. It has a ton of money. So even though they're making mistakes over here, they've done so many things right for so many years and accumulated so many assets and cash that they're able to survive even though they're making a lot of mistakes. And a company like General Electric, it would take an act of war pretty much to put it under, and that won't even do it because war is good for an economy actually. So a balance sheet is very important. Does the company have plenty of money and not too much debt? It's got to be cheap relative to other investments. A good stock is going to be cheap next to its competitors. Apple is an example. Apple is a great company, no doubt. But if you look at the price, the PE ratio, and the amount of prospects they have and how far they've already gone up, I wouldn't buy that with, way too expensive relative to other investments. You can buy another technology company right now, Cisco, let's take an example. Cisco is it's not as big as far as market cap because Apple has doubled since the beginning of the year. Another warning sign, we don't buy if it's doubled in 3 months. But Cisco does a lot more things than Apple does. Apple has 4 products, right? Cisco builds the internet, and it builds the wireless internet. It builds it in the United States as well as all over the world. Anybody who needs a networking system, they call Cisco. They do it all. They're the largest company in that business in the world. They're about 5 times bigger than any of their competitors. You'd have to take their next 5 companies, put them together to be as big as Cisco. Trades for $20 a share right now. PE is 10. Okay. Amazon. Amazon is another company. I love Amazon. Its PE is 126. 126. Okay. Salesforce, great company. PE 250. Okay, way too high. So we like to buy it when the profits are really there. Good future prospects. Is this company going to continue to grow? Does it have a good future ahead? That's what we're looking for. Those are the things that make a stock go up. Okay, whenever we buy something, we've got to look at the risks. So what are the risks of the market right now? One of the things that you might have heard a lot about is the hard landing in China. It's been a lot of talk lately about the hard landing in China. Looks like we're going to have a hard landing. All China, they can't do anything. I want to point out how the changes in China have occurred over the last 5 years. In the last 5 years, China's growth rate has been around anywhere from 12 to 18% per year. Okay? So let's start 5 years ago. It grew 15%, let's say. The following year, another 15%. But understand that 15% was on top of the 15% they already grew. So it started this big, now it's this big, then 15, then another 15, then another 15. Last year, really slow, went down to 13.5%. But it's grown from this to this. And the 13.5% was 13.5% more growth on top of the 15, on top of the 15, on top of the 15. So 15% growth of a company that's of a country that's already doubled is a lot more than 15% of a little company. See what I'm saying? It's exponential growth. This year it slowed down 7.5%. 7.5%, oh my gosh, they're having a hard landing. 7.5% is twice the speed we're growing right now. And if you look back at where it was a few years ago, it's bigger than 15% on that small base. So you see, even though it's 7.5%, it's still growing in a very, very strong way. It's not receding. There's not a recession. It's just growing at half the pace it's been growing over the last 5 years. That's good. The market likes slow growth, not, you know, something that's going to cause inflation. That kind of very fast growth causes a lot of inflationary problems. So we are not concerned about China. I'm glad it's 7.5%. If it was 15%, we'd have some worries. You would have concerns about inflation. The other worry, what's Congress going to do? You know, the spending, deficit spending. Okay. The deficit spending is reduced as the economy grows. Understand that. If you're spending $100 million, but the economy is worth, the GDP is trending at about $14 trillion right now in the United States. The amount of growth, the amount of debt that we have is about 60 to 70% of that. That's our deficit. 60%, 60 to 70% of the GDP is what we're looking at. Okay? That is about half of the amount of debt that they have in Europe. In Spain, in Portugal, Greece, they trend at 120 to 160% of GDP. So even though our spending, our deficit spending, everybody's concerned, it's good to be concerned,